Hello, Fred Muggs here with MCGRAW Realtors, and I'm here with Robby Cole with Benchmark Home Loans, and we're just going to do a quick question and answer session just to give you some ideas about maybe some different types of mortgages and how Robby can help you. He's one of my preferred lenders here in the village, and so let's get started. First thing is, Robby, I want to ask you, a lot of folks are asking about the mortgage rates now, and what is that looking like to buy now, or should we be waiting for the rates to go down lower than they are now?
Yeah, it's interesting. If you jump on FreddieMac.com, Freddie Mac is a quasi-government entity that keeps up with the movement of interest rates and tracks the data and the history behind it. While the Fed has adjusted the federal funds rate numerous times over the past 12 months, if you look at mortgage-backed securities, which is not the federal funds rate, they are economic indicators, they really haven't dove maybe as steep as people would like. So if you were waiting 12 months ago for the Fed to drop the overnight lending rate, they did 3 times, but mortgage-backed securities have kind of remained the same. So, the cost of waiting is getting into a new house, owning it, and allowing that appreciation to gain day after day, week after week, month after month. So, when interest rates were 21%, people still wanted to buy and sell real estate. When they went down to the 2s during COVID, people still wanted to buy and sell real estate. So obviously the sooner you buy, the sooner you gain by just sheer appreciation, no matter if the rates are 6s, 5s, or 10s. So
right, and I think with a lot of my clients, I'm telling them, buy now. You want to buy now. If the rates go down, you refi.
Right.
We just do refi.
Yeah, and the old adage is you're married to the house, but you're dating the rate, because another piece of data is census data that comes out every 10 years. The average mortgage is still only held about 60 months. It's only 5 years.
Really?
Whether it's a 30-year note, 25, or 15, the average person, not because they get into a house to refinance, but we're transient. Things change in life. Okay, grandma comes to live with us. Kids go off to college. All the other reasons. Divorce. Family size increasing. So, yeah.
Okay. So, is it good to get pre-qualified from the get-go?
There is no disadvantage in getting pre-approved.
Good. And that's what I talk to my buyers about, because I think you're the one that's going to help them make the budget. And then when I know the numbers, I can know what to look for to stay in that budget. So that's a great thing.
And two, especially if you're going after a property that may have multiple offers, the more information you have to make your offer strong and know you may have more than just one option against those other offers, whether it's closing sooner rather than later, whether it's a different loan type or that suits the property better. There's never a disadvantage to getting pre-approved.
Great. Yeah, and that way, do you do a loan disclosure for them where they can see what their principal interest?
Without a doubt. It's very common for us to have what we call a fact-finding, pre-purchase analysis appointment. That's what I've called it for years from one of my old coaches. We go over the nuts and bolts of, can you buy? How much can you buy? What's my payment? And how much do I need to close?
Right.
Okay, those are the 4 basics that I try to boil it down to. And then when somebody hones in on a property, then this is what I tell the clients. Hey, when you think you found the one, text me an address and we'll run the numbers on it so you know those numbers. So if you want to negotiate some concessions, where the closing cost max is, depending on your loan type. Again, the more information you have prior to making that offer, the stronger your offer is.
And in a lot of cases, people are wondering about cash, cash to bring to the table. What do you tell them about that?
Well, I obviously being in the lending business, I encourage people to hoard their cash. Normally people's cash can do better in the market, whether it be a 401k or an IRA or you know, savings, you know, a lot of times even just if it's in a mason jar, you know, if you're old enough to remember a mason jar. So we always set the approval up based on the individual needs of the client. One of our good friends with our company says, you know, everybody's mortgage is kind of like their own fingerprint, okay? Kind of like their credit score. Everybody's got a little bit of something unique. So some people may be more liquid or have just sold a home in Oregon or California or in Texas and moving here to, you know, to Arkansas. And they may have plenty of cash they want to put into a new house. But even then we kind of talk through that, you know. And so we base the approval based on their appetite for what they want to bring in to close between a down payment and closing costs, and set their payment up where they want to budget for it. We never want to leave anybody house rich and cash poor. So you marry all of that together for that one particular client to meet their individual needs.
Yeah, and I think in the village here, we've seen, you know, there's a high percentage of cash buyers because you've got retirees coming in here. But I think what we've seen lately is we've seen a lot more people keeping their cash in the markets because the stock market's been doing good lately.
50,000, right? I mean, you know, I'm old enough to remember, you know, it'll never go to 10,000. Well, it did.
Yeah. Right.
It hasn't looked back. So, yeah.
So interest rates, a lot of people ask, hey, what's the interest rate today, and how does that affect them with their credit?
I heard somebody answer that from the lender's perspective one time. What's the temperature in America?
Right.
Okay. All right. So that's kind of a
good.
broad question. What is the interest rate? So obviously, when those people ask that question, they're used to walking into a bank, a retail bank, where they have the placard out front that tell you what their CD rates are today, what their auto loan rates are today. Okay. I'm not with a retail bank, so we don't have the rate today. Okay? We have access to what the market is, depending on the investor that we go with, depending on the loan product that we go with. So if someone's buying, you know, let's say today a primary residence and they're putting 50% down, which is not uncommon in the village, then, you know, their rate may be in the 5s. But now if that same person called to go, oh, I'm actually maintaining my residence in California, but I want to buy this as a rental, okay, well then obviously their interest rate's going to be a little bit higher. So
interest rate drops while I'm in the middle of the loan process and the interest rate drops.
There's actually a term called a float down that some lenders have as an option. Let's say that you're building new construction and you're 6 months away from the completion of construction. You started when rates were at 6s and they go down to the 5s. Well, you as a lender know that that pre-approved prospect and buyer can go to another lender and get something lower. So some lenders will allow what they call a float down. If for some reason you did an extended lock on the rate to allow you to get to current market.
Is there a cost for that float down?
You know, the true answer is yes. Now, whether the lender chooses to pass that on to the buyer or the client is another question. So, on the extended lock programs, which are common with new construction beyond 90 days, 120 days, 180 days, a lot of times up front you go, okay, yeah, if there's a float down, there may be, you know, an 1/8 of a point fee or a 1/4 of a point fee or a 1/2 a point fee, depending on, you know, the length that the lender chooses to hedge in the future. But yeah, there is a thing called a float down option.
Okay. So some of the loan types that I've seen come back in, especially with new construction, are the ARMs. Are they coming back, and what's the advantage, maybe disadvantage of that?
Yeah, there, especially some of your, there are local banks that sometimes will dive into that market and fill their revenue with adjustable rate mortgages. Collectively, the mortgage market, the secondary market, it really still remembers 2008 and what happened prior to that, and ARM having a negative connotation. Adjustable rate mortgage, oh, that's a bad thing. Lenders took advantage of the public, bad lending. So it hasn't it's not like it was prior to 2008, okay? But there are arms out there, and if the client is suited to not have that mortgage and or understands the terms of that adjustable rate mortgage and is okay with that, that may be a product for them. But it's not for everybody.
Right. Okay. And I guess in the process of getting loan approval or getting a pre-qualification letter with applicants, do you put them through underwriting, automated underwriting, so they're, because I think as a real estate agent, you know, sometimes that's a stronger pre-qualification letter when they've gone through that process. They've given you guys a loan app, they've paid for their loan application fee, and they've really gone through that process. Is that something that your company does?
Yeah, we certainly can. We're fortunately here, okay, if we're specifically talking about, you know, your market for Hot Springs Village, top tier credit, most folks have saved, they've, you know, retired or close to retirement and know how to, you know, operate on a budget. So some of those, you don't have to necessarily go that deep. Now, let's change that to the other end of the spectrum. I took an application yesterday for some folks who live in Utah that have 14 investment properties all over the United States, and we're looking to buy a property here in Arkansas. And they had gone on a mission trip, so their real estate income had kind of gone down a little bit. So that one takes a little more on the front end. You want to review the taxes, you want to review their Schedule E net rental or the rental income, and lenders have to do a calculation. A lot of people don't know that. You just don't go, something's rented for $1,000 on the rental, and that's what you get to take. You have to do the net rental calc. And then automated underwriting system, all mortgage lenders at some point will use the automated underwriting system so they know how to underwrite that file per Fannie Mae, Freddie Mac, USDA, VA, FHA. And so doing it on the front end, especially if you know it's not a real simple, you know, retiree, fixed income, top tier credit, putting money in the bank. But yeah, the more due diligence that a lender can do on the front benefits everybody, for sure.
Absolutely, for sure. And I know for me, definitely it helps because that's a real strong pre-qual letter when they're going to that process of underwriting, for sure.
Yep.
Okay. And how long does it typically take for you guys to process and get us ready for closing?
In our market right now, you know, with volume, you know, 30 days or less is not uncommon. The industry average is still a little above 34 days, you know, from contract to close. We can do rushes if there's an emergency or a family issue, or a fallout from another lender, which we help out with quite a bit. And so we can, if we have to, close in 8 days.
8 days. Yeah, that's good.
Yeah,
that's great.
Yeah,
I like that. Well, good. Well, gosh, I can't think of anything else that we could ask you, but definitely, this is Fred Monks again with MCGRAW Realtors here in Hot Springs Village, Arkansas, and this is Robby Cole with Benchmark Home Loans. And if you want, I'm going to put a link to Robby's email, mine, and if you'd like to start the loan process, start a conversation with Robby or I, we'd love to have that conversation with you. Again, this is Fred Monks with MCGRAW Realtors. Please like and subscribe to the channel. Thanks a lot for watching.